The COB is brought to you by Pepperstone, trusted by traders in over 160 countries. From Barangaroo Studios, here's what you need to know about the day in business and finance.
Well, hello. Welcome to the COB. Great to be here with you and you. I'm Nadine Blaney.
And I'm Juliette Sarley. Yeah, a bit of a ho-hum day. Just really shows that we don't know what to do when we're left on our own, do we? No leader. Wall Street was closed. Even the UK was closed. We did see a little bit of a slightly higher move in Europe, but I would call today's action ho-hum.
Ho-hum, and also waiting, the weight of expectation. We do have inflation reads coming throughout this week. In fact, the ECB publishes its inflation expectation survey today. So because the ECB is widely expected to be one of the first central banks to cut, it'll be interesting.
Indeed. All right, let's get to our three themes because as we said, we're missing, we didn't see the market, did we? I'll quickly tell you what the market's doing. There we go, down 0.2%. And
disappointing.
Similar on the ASX 200, 16,771. All right, let's get to those three themes. We mentioned missing momentum on the market today with no leader to follow, and also just really this continued story, I guess, about the fact that we're not spending. That is the whole point of why we've got interest rates higher for longer. They're trying to stop us, I guess, spending too much. But you see it in so many updates, and what I think has been really interesting is the amount of updates in the car space. We had Bapcor, then we had Eagers, today we had Peter Warren Automotive, which fell something like 11%. So it's just really showing you that we are not, opening our wallets if we don't have to.
No, reading a note from Macquarie yesterday talking about, the fact that we could have more of these downgrades coming through, particularly in those consumer-related stocks, and even those retailers like Lovisa being called out by Macquarie. We've got Martin Crabb from Shaw Partners coming up. We will ask him about that one. But yeah, it all comes back to that retail sales read. And then, of course, going for gold, which was gold price.
The gold price looked quite good overnight. I guess that was on the lack of really any momentum from, as we mentioned, Wall Street being closed. But we're looking ahead to this core PCE indicator in the US. You've got gold at or near these records. We're looking at when we're going to see potential cuts from the Fed. But I was talking earlier to, I think, David Franklin from Argonaut, just talking again about the whole store of value. But I think what was interesting is that a lot of the smaller gold players did really well today. Spartan Resources up some 8%, Firefly up 3.3%. You've got Resolute Mining up by about 3%. Violeta Todorova just told me she really likes Ramelius as well.
All right, all of those interviews are online at ausbiz.com.au if you would like to have a little listen at your convenience. You're welcome. Let's get on to some of the sectors of the day. Utilities. It's not always the most exciting sector, and today was one of the many that were lower overall. In fact, if we take a look at the sector performance, we've got 8 out of 11 lower today.
Industrials, quick look there as well. Brambles, Transurban coming under a little bit of pressure. Yeah, it's just quite the ho-hum market, isn't it?
Yeah, and also in those real estate sensitive sectors, that includes, some of the REITs. We saw a little bit of a uptick there. We saw consumer staples looking all right, as well as materials probably. Again, it was just lackluster. It's a good point you make about the small gold miners, but BHP was flat to end the day. Rio up by just 0.25%.
All right, let's have a look at some of the top stories that we've been following. Pro Medicus, it disclosed 5 new contract wins in the US with worth a minimum of $45 million.
Yeah, Playside Studios, we heard last week that it was, got a bit of an uptick on a Game of Thrones game it's putting out. It also lifted its guidance today, so that gave it a bit of a boost. I know that some of our call viewers have asked us to review it, so we'll get that in there as soon as we can.
Peter Warren Automotive, I talked about this, issuing this profit warning, margins being squeezed by more competition in the sector. Also, of course, higher cost of living and the fact that we are just not opening our wallets.
Yeah, Serco. So in the tech space, the small caps tech space, it's a New Zealand company but listed here as well. It's narrowed its net loss to 15.9 million Kiwi dollars, but it was a pretty poor performance coming through today.
Yeah, and our stock of the day, Boss Energy. This was after news that basically the CEO, chair and director sold a portion of their shareholdings. All right, let's get to our guest of the day, Martin Crabb. Now, retail sales worse than expected, but as Paul Bloxham from HSBC told me, 0.1%, 0.2%. I mean, it's just a stall, right?
Well, it's a 50% miss, isn't it? 0.1
Nice,
to 0.5,
I like it.
0.2. Yeah, look, I suppose it's just added to the narrative that Peter Warren spoke about, that James Hardy spoke about, that Bapcor and AP Eagers have spoken about, and some of the small retailers, is that the consumer's slowing pretty fast. And so the retail sales number, although it was a little bit under, not a lot, it was still under. It's not a beat. We're seeing some economies where people are upgrading because the consumer's holding up really, really well, the US being the most notable, not the case here. So it's really odd to see bank share prices going up so much when it looks like the consumer's starting to suffer. They're certainly cutting back spending. And another interesting one I looked at today was Credit Corp. That stock's been under a lot of pressure. It got up to almost $20 and now it's down to about 14. Just as people are thinking maybe the consumer's in a bit worse shape than we thought. We've definitely seen them stopping spending. We haven't really seen them default on loans yet. Certainly not on mortgages anyway. But maybe that's coming, maybe that's around the corner. If these rates stay where they are until February next year, which is what we think, the squeeze that everyone's been talking about since the yield curve inverted, remember that, Nadine, back in early 2022, the recession signal, over 2 years ago, still haven't had the recession. Maybe it's coming, maybe we're starting to see the crack in the consumer.
I
finally.
remember that too, Martin. I may not have been here, but my lordy, we all talked about that a lot.
Yeah.
We talked about the mortgage cliff,
mortgage
which didn't
cliff,
eventuate.
exactly,
All right, given that then, when is it the right time to start considering beaten down companies that have downgraded, or retailers that have just been coming under a lot of pressure? Or is your style to wait till you start to get an upgrade coming through?
Yeah, you kind of, the old catching a falling knife analogy, you're better off not doing that. So we have seen stocks like Domino's, for example, because that's again a little bit of a consumer stock. That stock's come down a long way. That's starting to look interesting from a valuation perspective for the first time in forever. So I think where the company's got a longer term growth profile, like it's rolling out stores or whatever, then you've really got to pick your entry point. And obviously there is a cyclical element as well as a structural element with companies like that. I think you mentioned Lovisa before. I'd probably put that in that category as well. It seems to have a really good overseas growth strategy that you want to be a part of, because the format works really well in Oz and it seems to work overseas. Breville's probably another one, really good Aussie business that's growing globally. Domino's I'd put in that category. So they're consumer-facing stocks. They're going to get James Hardy knocked around in a cyclical downturn, but you've got to come back to the long-term valuation. So if they're longer-term store rollout or whatever strategy is still in place, if I discount that back, am I getting a share price that's material above where it's trading today, and I'll just suffer through it? One fund manager told me you buy the third downgrade, because typically after the third downgrade the stock doesn't go down.
Wow.
And so you wait for the third one. So I don't know if that's true, I haven't back tested that, but that sounds pretty good. So if a company's disappointed the market 3 times in a row, everyone
who wanted to leave was out.
Everyone's capitulated, so that's the time to step in and buy it.
I love that.
Interesting, right?
Yeah. All right. So then you're talking about what you're seeing with Credit Corp, and which is a debt collector. Going back to this whole theme, what does that show us about where the consumer is as well?
Yeah, I mean, I did a chart earlier this week, which I stuck on social media, which was looking at US auto delinquencies and US consumer card delinquencies. This is the bifurcation of Credit Corp in the black versus the banks index in the red. Now, if you look at it, I haven't gone back, 30 years or whatever, but just back to, a couple of years ago, the stocks seem to be relatively well correlated, because they're both providing credit, basically, right? Credit Corp's buying ledgers and then getting the money back, and the banks obviously take your deposits and give you a loan. And there's just been this huge bifurcation between the two, particularly since February, March this year. The banks have just been tearing, and yet Credit Corp's, as I said, almost from $20 down to 15. It just seems a bit odd, because if you put it in there, the auto companies are downgrading, the building materials companies, some of them anyway, are downgrading, some of the retailers are downgrading. Why are the banks just continuing to go? In fact, the banks got upgraded last night. One of the credit rating agencies gave them a ratings upgrade. So it just seems to be an anomaly, and I don't like anomalies. I want things all to make sense. So when I see things that doesn't make sense, there's an opportunity there. My perspective is the banks are overvalued, so I'm underweight the banks. But it could be that the banks are correctly priced, and some things are being thrown out with the bathwater like Credit Corp or some of these other stocks.
Correct me if I'm wrong, but does Credit Corp have a lot of exposure in the US?
Yeah.
So could that explain it though?
It could, yeah, it could. So it looks more clear that the consumer credit outlook in the States is deteriorating faster than it is here, despite the fact that student loans have been forgiven, because student loans are a big part of consumer debt, and they're pretty much not delinquent because you don't have to pay the money back, which is a little bit here. But auto loans and credit cards are definitely 30-day past due, which is new delinquencies. That's been heading up. So it could be more on the US side than the Aussie side. Yeah.
All right, well, talking about the US and just everything that we are waiting for Godot, I guess, the PCE indicator at the end of the week, and how important that is as we almost are in June.
Yeah. So that's always delayed. So I think that's April's. It's almost coming out the last day of May. So it's a little bit out of date. And most analysts have got enough data from the CPI to work out what the PCE is. So I think it's 0.27. So people can even go 2 decimal places on these things. I don't know why they bother, but so let's say 0.3 on, and I think the full year number's down to 2.7. And it's starting to get within a bull's roar of 2%, right? I mean, that's the Fed's favourite measure, and they take some things out of it, like like goods inflation, so they can get this core PCE, which is really what they're looking at. So if that's 2.7 and heading down, that suggests the central banks are close to being done. This is the rate futures in Australia. I just picked the peak day, which is back on the 1st of May, and that was after, I suppose, the hawkish pivot from Michelle Bullock, where she started to talk about the fact that they're considering rate hikes, and we were looking at a peak of 4.44 in November. We're now looking at 4.28, so 7 out of 25, so about a 1 in 3 chance of a rate cut by the end of the year, which is pretty much zero, but at least we're not pricing in hikes. And I think that was really spooking the market if the Reserve Bank's going to hike rates. But now we're back to cuts, albeit we think they'll wait until February or March next year.
All right.
Just a quick one. So June, I mean, do you get the sense that we're going to see a little bit of a pullback potentially?
No, it feels pretty good. I think we got through the difficult part for me, which was confession season, which was all those conferences. And I still think there might be a small cap conference on somewhere this month.
We're still getting some warnings coming through though, clearly.
Yeah.
Peter Warren, for example.
Yeah, but there's been a couple, but most companies that have presented at conferences, it's been a bit mixed. So I think we got through that. The next thing for us is probably earnings season in July, August.
Oh my God, that's coming around quickly, isn't it?
Scary.
All right, Martin, thank you. Can't believe it's almost
Martin.
winter and halfway through the year. Martin Crabb from Shaw & Partners. I think we touched on the fact that the stock of the day was Boss Energy. Let's have a look at who we heard from.
I just think it's a massive red flag, and obviously the market kind of agrees with me when you have insider selling in a project that's ramping up production, probably going into the highest return part of that mine, first normally. So it's really, it's not a stock we've owned. It's not something that we're particularly interested in, but certainly from my perspective, it doesn't pass the sort of initial smell test.
We're showing its returns being negative going forward. So we're investing with a target of 15 to 20% compound return. You've got no chance of doing that unless you really, really invest in quality companies and then buy them at a price that you can get the kind of returns.
Yep.
So all of them are, I cast a whole lot as just being purely speculative, which we don't do. So whether it's a good speculative investment or whatever, I don't know. Maybe it is, maybe it isn't.
There you go. You can listen to that full episode of The Call, ausbiz.com.au, or you can find that stock of the day in its entirety online as well.
Indeed. All right, let's have a look at the leaders and laggards as we have finished the day. Strike Energy there looking good. Nickel Industries, I was watching that on my screen, on my iris. It was a really bright spot all day, so a very big gain there. And Credit Corp that Martin was just talking about, quite interesting, a gain of about 3.7% today.
Strike Energy gave that update on its Werling operational update, so clearly there's something in that. I called the company a couple of weeks ago. I might give them another ring tomorrow and see if we can get the goods for you. All right, let's get to the laggards, and some stories in here with our stock of the day, off by 11%. Kelsian Group, no news. Helios, well, yesterday we did have the update on its strategic. It looks like it's going to be trying to offload its Loomis imaging business. SiteMinder and Audinate, so a couple in the tech space down as well. Audinate yesterday, saying that it was its long-term CFO, had left.
All right, well, coming up tonight, the US market reopens. Oh, wait, we forgot the small caps. There we go.
Wouldn't want to forget the small caps.
You
Well,
go
gold,
small cap.
hydrogen, it had a terrible day yesterday, obviously gaining some of that lost ground back up today, up by 7.8%. And we've got Peter Warren, one of the worst performers today. Juliet off by 11% on one of those really swift and sharp reactions to those downgrades. And I will also say that we'll be speaking with Dimmeric's CEO tomorrow. Yesterday had a great day on selling the rights to one of its products in the Middle East. A little bit of give back today, but we'll get the details for you again tomorrow.
All right, looking ahead now, I was getting so excited. The US market is coming back. The FHF House Price Index, consumer confidence coming through as well. I don't know what CB stands for. Is that a specific
conference board, maybe?
Yeah,
conference
okay.
board. And the FOMC, Cook and Daly. So again, more Fed speak. Is it starting to confuse the message? Well, the jury is out on that one, but of course we're leading toward the inflation data that comes later in the week.
Indeed. All right, let's have a quick look. Tomorrow we get I don't think we get GDP, do we? Don't we get inflation data tomorrow? That's the key one.
Yeah.
So let's bring that down here, and that's not right. Inflation data is tomorrow, which is the key that we'll be watching out for. And then, of course, we've got trade balance in New Zealand and consumer confidence in Japan.
I will say, this is the monthly inflation read, so not the quarterly one. And when we were chatting with Shane Oliver from AMP on Friday, he was saying he's probably the only economist out there who doesn't think this data point has added anything valuable to the conversation.
Wow.
A little bit of a murky there. And also on Wednesday, we are looking at some further information on the U.S. economy coming from the Richmond Fed, and then we get the Federal Reserve Beige Book. So always lots to talk about.
Indeed. It's never a dull moment in markets, apart from today, which was a little dull.
And so the final figure for the S&P ASX 200, if you look at the COB Australia, they're moving pretty similar to that one. So we're sitting at 7,766, down by 0.28%. But the E-minis, now I know this doesn't necessarily come to fruition in terms of market performance through the session, but E-minis, S&P and NASDAQ are both looking higher at this stage.
All right. Well, that does it for this Tuesday. We will be back tomorrow from 9:40 Eastern. Join us then.
The COB is brought to you by Pepperstone, trusted by traders in over 160 countries.
Gil.
Oh, hey, Ken.
Here we go.
You still trading?
Pepperstone. Trusted in over 160 countries. You?
Well, I'm still with...
I don't think anyone trusts them.
No, I'm fine with it. Just like I'm fine with my trusty coach. 1980s John McEnroe.
Pathetic! Horrible! 1980s, huh? So, really temperamental?
Keeps me on my toes.
Awful! It's a bit intense.
Be better!
Still fine with it.
Use your racket!
He's just staring at us.
Yeah, sometimes he yells and then sometimes he just stares.
Is he aiming for your face, Gil?
He's fine with it!
Yeah, he's definitely trying to hit you.
Fine with it.
Don't be fine with it. Switch to Pepperstone, trusted by traders in over 160 countries.
Come on, you cannot be serious!
Don't do that.
Ow.